Hello and welcome to the January 2026 market update from Fairstone Ireland. Really interesting month from an investment perspective. If I told you at the start of this year that during the month of January alone that we would have seen an increase in trade tensions, potential US looking to annex Greenland, or if I told you that they'd captured the Venezuelan president and that we would have the announcement of a new chair of the US Federal Reserve, you would have expected possibly some very negative returns from markets. Hasn't been the case, but we've seen quite a lot of change under the bonnet of the investment engine so far this year. So we're just going to look through some of the highlights during the month of January so far. And last year when we were doing these updates, we would have talked quite a lot about the Magnificent Seven. So these are the big technology giants, the Teslas, Amazons, Microsofts, Apple and so on. Big drivers of investment markets for the last couple of years. Not so much during the month of January, and we've seen what we call a rotation has been taking place, not just from the Magnificent Seven into other industry sectors. We've also seen other geographies doing particularly well and less so the United States. So during the month of January we saw Asia Pacific shares doing very, very well. Japanese shares doing so well on the back of announcements of new leadership in Japan. Madam Takaichi is coming out with plans to reflate the economy, to cut taxes on food and particularly rice, and then she announced a snap general election as well. Emerging markets love a weaker dollar, and we saw a very, very weakened dollar right throughout the month of January, and that boosts the returns that they can achieve on what they're selling into more developed economies and particularly into the United States as well. So, quite a lot of change within the markets that you're looking at out there. If you look a bit closer to home, we've seen US markets doing worse than European markets again, a bit like what we saw last year, and just across the water in the UK, a strong month for the FTSE 100 as well. So what we are seeing a little bit is areas of the investment world that were doing extremely well, these very, very high growth stocks. The market is looking at them and wondering, can they continue to grow at phenomenal rate? And also, what do they need to spend to maintain that level of growth? So a little bit of nervousness about capital expenditure and how long it will take to see those returns coming through. And if they don't generate the spectacular returns, what do we see? We see the markets reacting in a very ugly manner. And a simple example of that was Microsoft came out with really strong results, good expectations of future results. Market didn't really like their capital expenditure plans or how long it's going to take to get a payback on all this huge expenditure, and the share price, instead of responding well to strong results, got hit for about 10% during that month. And that's just really one example of the earnings season that we saw in January. So overall, company earnings have been very strong, good revenue numbers coming through, very strong profitability coming through as well. So over 75% of the companies that have reported earnings so far, very, very healthy. So what we've said again and again on these updates is the investment markets are a bit more focused on company profitability and economic growth, and global economic growth is looking reasonably healthy at the moment. It is so hard to predict who are the winners and losers in investment markets. But globally we're starting to see very, very strong returns. The bond market should make up a part of your portfolio as well. It gives you that bit of stability and ballast. Modest returns during the month, and European bonds doing a little bit better than most corporate bonds, having an okay month as well. So once again, what we've seen here is the importance of diversification. So hard to predict what shares are going to do very well, so hard to predict what geography is going to do very well, and we have this rotation from some of the rapidly high growth areas into some of those that may be trundling along, delivering decent returns over time. So there's an old phrase that all that glitters is not gold. What we've seen over the past year or two has been spectacular returns from investing in the yellow shiny stuff. It went through $3,000 an ounce to $4,000 and even $5,000 an ounce. So there was a lot of speculation involved in this, a lot of central banks buying it. Why were they buying so much gold? A lot of worries about the size of how much debt the US government had accumulated. A bit of worries about the strength of the US dollar as well. So a number of different factors were driving it up. There was no doubt quite a strong speculative element to it as well. And when the dollar is weak in particular, people tend to see gold as a useful place to put money, as well as being a good safe haven at times of rising inflation. So lots of things have been supporting gold for some period of time. Interesting, last week we saw a little bit of a bursting of the gold bubble, and not just gold but silver and some other minerals as well, because silver has also been on quite a tear over the last year or so. What we saw in one single day's trading, we saw gold falling by about 12% and we saw silver falling by 36% in one single month. Why was this? A lot of it was down to concerns that the new chairman of the US Central Bank, known as the Federal Reserve, a guy called Kevin Walsh, would be less likely to cut interest rates, which supported the dollar. So we saw the dollar strengthen, the dollar went up, gold went down, and silver followed even more quickly. A lot of the speculative element of the market was kind of found out all of a sudden. There's an old phrase of investing, it is only when the tide goes out that you see who's not wearing any clothes, and we saw a huge amount of sudden emergency selling taking place in that market. Here in Fairstone, we talk about long-term investing, getting good returns by having well-diversified portfolios, not trying to find the next bandwagon to jump on, because most people see a bandwagon from behind.